Welcome back. This is the second lesson in the mini course on maximizing your profits with VWAP. In this lecture, I will continue to explore different ways we can use volume weighted average price, aka VWAP, in your strategies. Today, I'll talk about using VWAP as a mean reversion target. The premise of this setup is to have the price away from VWAP, which means that at some point during the session, the market jumped away from VWAP. And then during the course of the session, another level gets reached, usually a standard deviation band or something else, and then the expectation is that the price will return to VWAP as a target, as a mean reversion. So here's what I mean. On this chart, I have gold futures. Gold futures is one of my favorite products. Now, these gray bands represent the first and the second standard deviation. I am using Blahtech VWAP for Metatrader 5. I use AMP futures Metatrader where you have real futures contracts. So this is not a CFD. We don't do CFDs. These are genuine futures. Okay, so the price goes up away from VWAP. It reaches the second standard deviation and then creates a reversal, which we can clearly see by this inverted hammer red candle here. And then the price goes nearly all the way down back to within 2 ticks from VWAP for about a 48 tick profit. So this whole move just from here down to here, that's a 48 tick move. So even on one contract on gold, that would be like $480 profit. Now, what follows, if you watched my first lecture in this mini course, is that VWAP actually acts as a key level as well, and then carries on into the end of the session. You can see here where the bands end, that's the end of Globex, which is the end of electronic trading for the day. Now, this strategy, using VWAP as a mean reversion target, it really needs 3 things. It needs 3 conditions before you can successfully execute it. 1, the price has to be away from VWAP, but not too far. I'm going to talk about that in a minute. Number 2, it has to pierce the second standard deviation curve. And number 3, it has to give a reversal pattern. If you don't have all 3, it is not a good setup. It's guesswork, wishful thinking. As some of you already know, whenever I'm explaining a strategy or a setup, I want you to know the challenges with it and the clues that a setup may not work out, as well as knowing the positive conditions for the setup. I would even argue that knowing when the setup is not going to work out is actually even more important. So one challenge is that when you're entering a trade, you need to ensure that there is a reversal pattern. So let me repeat this again. It is paramount that all 3 conditions are present. Whenever people come to me for performance coaching, immediately I see that they make the mistake of taking half-hearted trades without actually waiting for a reversal pattern to appear. And in this particular setup, like many other setups, we cannot do that because that is impulsive behavior. I call it grasshoppering. I have another trader who calls it the Mystic Meg moment, which is very apt. And if you keep doing that, if you keep guessing, that's never going to make you into a consistently profitable trader, especially if you don't know the stats behind the setups and if you don't know which setups 100% require a reversal pattern and which setups don't. Because let's face it, not all setups require a reversal price pattern and some don't even need a price pattern at all. We need some kind of a different key level, but not necessarily a pattern. Intraday trading means mastering all types of trades. Reversals, continuations, breakouts, ranging trades. So even if you have the second standard deviation that was reached, entering a reversal trade without waiting for the final condition to happen, without the reversal pattern, that's dangerous. You don't want to be guessing. We want to make educated trading decisions based on the conditions that we already have. Don't make stuff up. It's not necessary. Less Mystic Meg, more Market Stalker. Big difference. Now, if I show you this example, this downside move is what we're looking at. So the second standard deviation does get reached, but the move just keeps going and going and going. So if you're constantly attempting to fade that, fading the piercing of the band, you'll just keep deepening the drawdown. That's not the way. So please ensure that you have a decent reversal pattern before you attempt this trade. The second challenge with this trade is when you have a strong trending day and the price moves ridiculously far away from VWAP very quickly. I've then had traders who are going, wow, the profit margin back to VWAP is enormous. And yes, VWAP might be like 200-300 ticks away, but I wish things were that simple. If the prices move so far away, it is usually a repricing event, which means some kind of a rate decision or another game changer event has caused the price to go to another level entirely. And for those kind of events, a full return to VWAP is actually not a good strategy because it just won't happen that day. So I must bring up that context. I consider myself, I suppose, mainly a technical trader, but you still have to have a basic understanding between a slightly mispriced opportunity and a complete change in underlying conditions. If I go back to the example that I just showed you, the price went jumping off a cliff here for like about 400 ticks. And yes, there was a pullback, but this VWAP, which is a purple line here, was about 180 ticks back the other way. On days like this, where VWAP is pretty far away at the time of the reversal pattern appearing, using just VWAP as a target is just not a very good solution. A better option would be to use something else, maybe like a TPO profile from the market profile concepts, and then to look for an area where the price might have made a little speed bump. And you can kind of see that if you have a very keen eye with the candlesticks in areas where this wick of the previous candle kind of overlaps with the body of the next candle. But it's kind of hard to see just using candlesticks. However, on the profile, on the TPO profile, especially our graphic overlay from Blahtech MP, it actually becomes really, really obvious. The speed bump that I was just talking about is right here. And look where the price pulled back to into the close. Not VWAP, but the speed bump. Interesting. So be realistic with what's possible on a day where the price goes on a run. Now finally, there is a probability enhancer for this strategy. It's all very well just using the second standard deviation curve. But if I go back to this chart, I will draw your attention to the blue line up here, exactly where the price turned around. Now the blue line is actually the settlement price from the previous day COMEX trading. COMEX settlement used to be a part of open outcry trading, so once upon a time, prior to electronic trading, that would have been it for the day. The market will close and you wouldn't be able to open new positions or close the existing ones. Now, since the advent of electronic trading and a few changes in the industry, we now have a session called Globex. So while settlement price is still announced at the same time as the open outcry settlement price used to be announced, and the volumes might fall off quite a bit after settlement, the electronic trading actually continues. But the settlement price still carries quite a bit of weight. So this settlement line here, that's your probability enhancer for this setup. So here are the conditions for the improved probability of this VWAP mean reversion setup. Obviously, price first needs to break away from the VWAP area. And then once you detect that second standard deviation curve getting pierced, plus the settlement price from the previous trading day getting tested around a similar area, similar zone of interest, aka Zoe, and then if you also get a reversal pattern, you then have a solid increased probability on your hands. To finish up this lesson, I'm gonna show you a trade that I took on crude oil futures. It didn't have the settlement line, but it did have another high probability level there instead of settlement that I paired up with the piercing of the standard deviation bands. And that particular level is actually a part of my market stalkers method. However, the core idea for the trade location was the second standard deviation plus price reversal and then back to VWAP. Enjoy! Alright, here I have a chart of crude oil. This is a 15-minute chart and the distance to VWAP is some 76 ticks, which is pretty decent. It's not too far away. And this is exactly what I'm saying with the piercing of the the standard deviation curve and then waiting for the reversal pattern to appear. Obviously there was a consolidation earlier on. That wasn't quite enough. So now that I have this reversal pattern, I can enter my trade. So it's going to be a long trade. Obviously we're trying to go back to VWAP. Now usually I tend to use anywhere from about 30 to 45, maybe even 50 ticks stops on crude oil, depending on how big the session ranges are for that particular period of the year. They went a bit nuts during COVID, but now we're kind of back to some normality. I don't like the fact that my stop loss is right under that round number, so I am going to widen the stop loss a little bit just to avoid getting whipped out on a round number. So that means that my profit target is probably going to fall to about 1.5R rather than 2R, which is still fine. It is still very statistically viable, especially on the kind of hit rate that I have at the moment. Yeah, so 1.5R, just under VWAP. Usually I try to only take profits close to the area rather than being a dick for a tick. That never works. So my profit target is actually ever so slightly below the actual VWAP. Nothing else for me to do. I'm gonna speed up parts of this video because otherwise it's gonna get very boring. So yeah, let's see what happens. Alright, so we just had a NYMEX open, so it is pushing a little bit into a drawdown. This is why I like to use slightly wider stop losses than most of your intraday traders, because I don't really aim for any sort of sniper-like accuracy, but yeah, we'll see what happens. This is now coming in from London trading into NYMEX open when you get increasing volume. Like a huge increase of volume, but also you have the bigger candles occurring and then bigger reversals too. So this is a trade that I'm carrying over from London. So that's why you can expect at least a test of the round number that I was talking about earlier. And the reason why I try to stay away from round numbers is because they get tested very frequently. And then I can hear some people going, well, if you know that this is going to happen, why don't you just put a limit order at the round number? Well, because quite simply, I don't really like using limit orders. I prefer market orders. So even when this happens, when the round number gets tested, I will still wait for some kind of a reversal pattern, meaning that my entry is not going to be that different. And when I've tried that in the past, like maybe about 7 or 8 years ago, when I was still honing my own strategies, and unfortunately, I would end up in a worse position or miss the move altogether. So, you know, I found something that works for me, and I'm actually okay with some of these drawdowns, especially if I'm trading through the overlap between London and NYMEX. And you won't see me do these sort of trades very often, but today I have 3 different concepts that I use telling me that we have a mean reversion potential. Like, first of all, there is an average daily range exhaustion around these levels as well, which is not on this chart to avoid the clutter. Then I have the standard deviation pierced and a reversal pattern. And finally, I can also see that the price is opening at NYMEX quite a bit below yesterday's business. So when that happens, it means I have a stack of conditions from 3 different concepts that are all telling me the same thing. So that's a strong setup, and I will always pounce whenever something like that appears on my charts. All right, let's wait some more and see what happens. Alright, well, it's very close to my target now, so I'm going to be either planning my exit if this doesn't actually hit my actual target very soon. As you can see, the mean reversion happens pretty quickly here, and it's because, like I said, the market is a little bit overstretched today, so it's kind of like being on an elastic band. It pings back very quickly. True mean reversions typically are completed within like 2 time frame periods, but if you don't know what you're looking for, and if you are not as quick to take advantage of it, or you're on the other side of it, it gets very scary. But this particular trade was reasonably drama-free, a bit of a drawdown at the start of NYMEX, and pretty smooth sailing since. Alright, so that's it. My trade has reached its target of 1.5, and that marks the end of this video. Thank you for watching, and I'll see you next time.